Hi, I'm Chris Heisey, Chief Investment Officer for Merrill and Bank of America Private Bank. Today, we're looking at one of the most notable shifts in our outlook for 2026, which is a more positive stance on emerging markets. A strong 2025 performance, a broadening global expansion, and a dollar that appears overvalued are contributing to this shift, along with tailwinds including potential lower interest rates and easing of oil prices. With capital rotating back into emerging assets, now is potentially a pivotal time to assess EM in your portfolio. What's behind these trends and what do they mean for investors? Joining me now is Senior Investment Strategist Lauren Sanfilippo to break it all down. Lauren, welcome.
Hi, Chris.
We're going to start at the top. We have this concept called what's rare this year. What's rare in terms of growth around the world, whether it's the U.S., potentially above 5% nominal growth. Around the world, collectively, 6%, at the time where short interest rates in the States are coming down. Typically, when you see geopolitical activity rise, you get a stronger dollar, not a weaker dollar like we've seen recently. There's a lot of rarities out there. Let's start with the emerging markets, and let's go into what is different with the emerging markets within the context of what just happened in 2025.
What's rare is that the emerging markets actually outperformed, almost put up double the performance that the U.S. did last year. And so in that sense, we're coming into the year already with markets a little bit hot. And so I think the setup is a little bit rare this year. It's just a story of chronic underperformance from the emerging markets. But a lot of the forces now have aligned, whereas global growth is narrowing. The divergence is narrowing between the rest of the world and the U.S. That's one. Earnings momentum looks good for emerging markets. We have global trade that's reaccelerating. So there's a lot of good things that are happening that are rare in a sense for emerging markets.
When we bucket the emerging markets all together, we can't look away from the fact that overwhelmingly large part of the index is China. We'll get there in just one second. But when we put all of the emerging nations together as an asset class, what type of earnings growth are we expecting? Is it above what the U.S. can potentially create for all of 26?
Yeah, it's roughly in line with the U.S., but just different factors, right? So whereas in the U.S., we're looking at earnings that instead of it just being powered by 7 tech companies, hyperscalers, overwhelmingly, their earnings growth is decelerating. And we're seeing the broadening from the 493 come up behind that tech sort of earnings outperformance that we've seen in recent years. Now, for EM, the story is a little bit different, right? And some of those earnings trends just look really good. You're looking at, for example, the tech-oriented economies and markets, right, that we think are very compelling opportunities in 2026.
Let's talk about China. A few years ago, China technology segment of China itself kind of went to the wayside a little bit. We didn't really talk about it, even though they were building this so-called dominance, or at least race for dominance against the U.S. And then all of a sudden, they're supportive. There's particular government expenditures that are supportive of China technology in general. But also we're starting to hear about other stimulus with the consumer. Is that a contributing factor to being overweight the emerging markets?
There's a lot going right in China now, where that wind has really changed, right? And it's 27% of the EM index, and so this is a weight that matters. It's a little bit similar in Latin America, actually, different EM here, in the sense that Mexico takes up a lot of that index, and so concentration is a risk.
Right. You talked about earnings growth. We talk about valuation in the United States as being at a premium. What's the valuation like collectively in the emerging markets?
Yeah, so actually valuation is a compelling opportunity in emerging markets. And, where there's been concerns over AI, maybe these valuations got a little bit lofty for some investors here in the U.S., you can actually look for those opportunities abroad at valuations that could be more attractive, right? So I'm talking about tech-oriented markets such as Korea, Taiwan, even China. And so that's what we're looking at for this year.
There's been a lot of changes politically in the emerging markets over the years. It seems to be relatively calm right now. When we think about an active way to think about the emerging markets, is geopolitical risk still one of the bigger risks out there as it relates to the direction of asset prices?
Geopolitical risks are very much so part of the equation this year. We've seen what's gone on just year to date, right? In the few trading weeks that we've had.
Feels like a half a year already.
For sure. And in front of us is still the IEEPA Supreme Court ruling, the emergency powers over the tariffs. So trade and tariff frictions, very much part of the story this year still, right? That unfortunately didn't go away with 2025.
One of the great benefits, at least right now, could potentially be the fact that dollar-based investors are significantly underweight emerging assets in general, emerging equity assets, partially on the debt side as well. And with money flow, what other drivers are you thinking about with reallocation?
The dollar we see is still weakening this year, right? Nothing like the 7% on a trade-weighted basis dollar decline we saw last year, which primarily took place in the first half of the year.
Right.
We foresee for this year still a softening in the U.S. dollar. And so that would be a contributor and accretive to emerging markets still.
That's a very good point, because if you get the weaker dollar, you get earnings growth, you get global growth going up. What tends to follow is natural resource prices also rallying, which we have seen in some cases, not just precious metals, but base metals and other parts of the natural resource spectrum. Is what is expected as well in 26?
Yeah, and I think you could also see like some of the industrial uses for some of those metals, right? That's actually an attractive investment opportunity, I think, for us this year, particularly looking at LATAM, just as a region that would probably benefit from that.
Lauren, we talked about earnings growth and valuation, some other factors. Years ago, for many decades, frankly, there was a high correlation to rising oil prices with enthusiasm, particularly as it relates to Latin America within emerging markets. Do oil price direction matter just as much today as it did in the past, or is there a different approach?
Different in the sense that China's growth model has changed a little bit, where it felt like in years prior it was more like boom bust,
Right.
depending on what's happening in the commodity landscape, sort of what's happening in China, right, and vice versa. Now it's a lot different in the sense that China has actually tried to become more consumption-based, right? And so they're moving towards this. It's happening slowly. I mean, they did print a $1.2 trillion trade surplus last year, and so they're still very much export-oriented, but they are moving towards this more consumption-based model.
So an overall more diversified approach as to what is driving the enthusiasm over the emerging market landscape.
That's right.
What are we missing? We talked about geopolitical risks. Is there anything else top of mind that you might be guarded about for us to watch for as it relates to emerging markets in general?
Yeah, I mean, maybe a global growth scare. It's all these things that we would probably factor in that just aren't right now factored into our models and assumptions, right? So there are certainly things that could take place, but the overarching idea is that an EM allocation would be a sleeve in the portfolio, right? In the sense that, while this has been a great conversation about emerging markets, we have that U.S. bias, and that's the core of the portfolio. So this would just be a little bit of a bolt-on, right? The diversified sort of aspects to a portfolio.
Something that a dollar-based investor hadn't had to think about for a very long period of time.
Or wasn't able to.
Great point. Lauren, I want to thank you for joining me today.
Thank you so much.
Emerging markets are clearly an important part to consider for a balanced portfolio in 2026 and beyond, alongside other shifts in asset classes and sector positioning. For guidance tailored to your long-term goals, connect with your advisor if you work with one in order to see how these trends could work for you. I'm Chris Heisey. Thanks for watching, and we'll see you next time.